Hello there, welcome to Market Call. Our guest is Rebecca Teltscher, Portfolio Manager at Newhaven Asset Management, and she'll be taking your questions on Canadian Dividend Stocks. Call Rebecca toll-free, 1-855-326-6266, or send an email to marketcall@bnnbloomberg.ca. Great to see you as ever, Rebecca.
Thanks so much
for joining us. I was amazed today. I didn't realize Microsoft was down about 18% this year.
Yeah, I mean, it's not just Microsoft. Look at Amazon, look at Netflix. A lot of these tech names, whether it's the large hyperscalers or even, I mean, we know what's happening in the software, but a lot of these overvalued or high-valued stocks, particularly in the tech sector, are getting rotated out. And it's interesting for us. I mean, we've avoided that sector for the past few years, for better or for worse. But, you know, we're starting to now see a lot of momentum into more defensive stocks, into hard assets, into value stocks, dividend stocks. And also, the nice thing is we're seeing some flow out of the U.S. and back into Canada. So, you know, while I think I've been saying this for over a year now, I'm nervous about the markets, but I'm less nervous about the Canadian market versus the U.S., and I'm less nervous about, you know, the names that we own, which are more defensive infrastructure names versus the broad-based market.
I see Enbridge got a downgrade at Jefferies. Jefferies saying the money has flowed out of techs into things like energy and mid-market energy players.
He's not wrong, and I think TD announced either today or recently they, I think, downgraded all the not the utilities, but the pipes. I think TRAP, Pembina, and Enbridge. He's not wrong in terms of valuations are higher than they have been a year ago, and they are trading at the higher end of their 5 or 10-year average. That being said, where else are we going to put money right now? I don't think he's wrong. Maybe he's wrong on the timing, because I still think that trade is not over yet. I still think I'd rather have my money in an Enbridge that, let's just say, is maybe trading at the higher end of its value, you know, 5-year valuation, maybe trading at 18 to 20 times earnings. But it's also paying me a 5.5% dividend. It's growing at 5% consistently. And, you know, a lot of these projects are, you know, backed by long-term contracts. The revenue is stable and the growth is pretty secure. Where else am I going to get that kind of return profile and that safety profile? You know, if we compare it to other sectors that are trading at higher valuations like tech, you don't have that dividend yield. You know, we've seen the money flow out of, let's just say, cryptos. Bitcoin is down almost half since its peak. Yeah. Right. You know, gold is usually the flight to safety, but I would question how safe is it when you're trading at multiples that are this high. So where else are you going to put money right now? I feel a lot more comfortable owning an Enbridge that has hard assets, real dividend, and consistent growth than some of the other alternatives.
And this, I'm sure, will come up on the show because we're talking about dividend stocks. But what about the Canadian banks, the good old Canadian banks? Maybe we can put up a 1 year for the Canadian Bank Stock Index. That has, over the past few weeks, been hitting records.
Yeah, and it's funny because we like the Canadian banks in general, but I have had trouble adding to them in the past year. We're seeing, you know, like was it TD that was up over 50%? You know, the banks have had a 30 to 40% move in the past year. A lot of that beat was from provisions that they took, like they took too many provisions and now they've put them back into earnings. I think that was a little bit preemptive. I hope it's not, but I'm not 100% comfortable with the banks in the short term. I'm okay with the banks over a long term. I think they're going to be okay. I'm not worried about a dividend cut. I'm not worried about these banks going bankrupt. Valuations are getting me a little bit nervous right now. I think some of those earnings beats are low quality beats.
We're looking forward to having you here. So dividend stocks, what about REITs? Are they on your agenda, or would you rather stick to plain old dividends?
Again, you know, it's funny. Ryan and I looked at Allied Properties about 2 years ago. Oh my God, thank God we didn't go into that. You know, that had been a disaster. I mean, some of those valuations are becoming more attractive right now, but I think that it's too soon to start looking into some of those REITs. I think what's happening in the real estate sector, particularly in Canada, I think is just beginning. I think it's closer to the beginning than the end of whatever cycle that we're entering.
Closer to the beginning?
It looks like it. So, I mean, we're holding off. I mean, I do think that there is some good, dividend yield there, and valuations are coming back to where, versus 2-3 years ago. And again, when you look at REITs, you have to be very subsector specific. Is it a retail REIT? Is it a senior housing REIT? Is it a apartment REIT? So that they all have different profiles, and industrial REITs. They will all have different profiles. They will all move differently depending on where we are in the economic cycle.
It's great to have you here. And actually, but while we're on REITs, today, should people pose you questions just on dividend stocks, or are you okay taking questions on REITs, or would you rather stick with plain old dividend stocks?
I could take some questions on REITs too, or dividend stocks. Listen, I don't pretend to be an expert and know everything. If I know about it, I'll talk about it. Maybe talk a little too much about it.
No, we never get tired of listening to you. Rebecca, thanks very much for joining us. Rebecca Teltscher, Portfolio Manager, Newhaven Asset Management, and the topic today, Canadian Dividend Stocks. 1-855-326-6266. We'll kick off with an email from Ted. Ted says, can I get the guest's opinion on WELL Health?
Yeah, that's a good question. It's funny because on paper, it may if you're not aware, WELL Health, they are the largest operators of clinics, medical clinics in Canada. They have about 220 clinics total. They just announced an acquisition recently of 8 new clinics in Alberta.
And it's testing centers as well, is it?
You know what? I'm not exactly
sure.
I don't know it so well, but I can,
brick and mortar anyway.
Yeah, they do also a lot of the virtual stuff, like the e-consults and things like that. It was one of actually the pandemic darlings because of, it was focusing on, health. So, for example, it uses like the Medio platform for doctors to communicate electronically to patients and things like that. Mm-hmm. They also have the physical clinics. It's one of those things that it should work, right? We love sectors that focus on needs, not wants, and this would qualify. But the stock just can't get its footing. I mean, it's down, I think, 50% from the pandemic highs. And I think, the regulatory environment when it comes to healthcare is not great, particularly in Canada. There's a physician shortage. So, the business model is reliant on physicians. And there's a lot of healthcare regulations that can get in the way. So we have stayed away from it. There's also no dividend yield on that. So, it's something. And then it's a little bit riskier. I think it's only about $1 billion in market cap. So, it sounds like a good idea in theory, which is why I took a look at it, but there was just too many risks. Any business that relies too much on governments and regulations worries me.
Yeah, it's amazing. They say we operate the largest outpatient medical clinic network in Canada, so they are big. Yeah. Interesting. I mean, they're it's a kind of a privatization of healthcare in a way.
Right. And what we've seen about healthcare in Canada is the regulations are so different, whether it's in Quebec, Ontario, Alberta. So again, lots of regulatory hurdles that will differentiate. So, that efficiency you won't get, province to province because this is a provincial regulated mandate.
Yeah, I mean, it's ridiculous. In some provinces, pharmacists are allowed to administer some vaccines, and in others, they aren't, which strikes me as crazy. I mean, Canadians have the same physiology wherever you go.
Absolutely. And then, certain vaccines are covered, by insurance or covered by the government in one province and not the other. So lots of, differing. And then I'm sure the fees collected, by WELL Health, in terms of physician visits are going to differentiate and are subject to change, by the political or the regulatory environment.
But you're not convinced by it yet?
No.
Oh, okay. We've got Rob in Calgary. Go ahead, please.
Hi, thanks for taking my call. I'd like to get Rebecca's opinion on Algonquin Power. I have a multi-part question. First, would Rebecca buy, sell, or hold this stock? And second, does she see the potential for it as a potential takeout target? And lastly, does she prefer another player in this space? Thanks again for your advice, and have a good afternoon.
Thanks.
So you actually took it right out of my mouth. I do think that Algonquin could be a potential takeout candidate. That's not why we own it, so we do own it. It's done pretty well. It was up almost 40% last year. And again, because it was a utility that generally lagged the other larger utilities, again, it has a history of A bit of a problematic history, 2 dividend cuts. It was, before the transformation, it was, half power, half utilities. They've done a good job of cleaning up the company. So they've sold off their renewable assets. I think they kept the hydro for now. I'm not sure if they've sold that yet. But they are basically transforming into a pure play utility, which is what we want to see. They have a new management team. They're doing the right things. I think, when they had their investor day last year, the stock was up 10 or 12%. So the company is delivering. It's a new company right now, but they are still trading. They are the cheapest valued pure play utility that you can find in Canada. So that's why one, we think it's a good investable asset. It's one of our smallest utility holdings, but we still own it. And that would also make it a potential takeout candidate. With regards to if we own another one, I have another utility. That's my top pick. I love almost all our utilities. It is our biggest holding. We are very positive in the sector in general with regards to what's happening in the macro environment in North America with regards to, whether it's data centers, whether it's the move from coal to renewables or gas, whether it's bringing industrial production back into North America. There's so many different drivers that are pushing the need for power demand and new utility infrastructure builds. So we like a lot of the different utilities, Algonquin being one of them, but I'll talk about another one of my top picks as well.
Okay. And as you say, they did sell off their renewables portfolio. Okay.
Yes, I think they kept their hydro assets for now.
Right. Okay. John in Milford, Ontario. Good to hear from you. Go ahead.
Hello, Rebecca and Andrew. I haven't seen you in a while.
No, I haven't been on this show for a while, filling in today.
I haven't seen you in Milford even.
No, I was there on the weekend. Plenty of snow. Beautiful. It was so peaceful, Milford, Ontario.
Yep. Anyway, I'd like your thought. You kind of took the wind out of me. I kind of like your thought on Enbridge. I'm in the low 40s, and should I wait a while and let it trade out a bit? What's your thoughts? Thank you. I'd like to buy some more shares. Thank you very much. Bye.
Thanks.
It's funny. The company reported earnings, I believe, on Friday, and the stock jumped, I think, 4%. And then, as we talked about, there were some downgrades this morning, and then it gave it all right back. But essentially, listen, they had a really strong quarter. They're doing everything they said they're going to do. They have about I think they commissioned about $39 billion in CapEx. And they put $8 billion of projects in service last year. They're going to do about the same this year in 2026, 5% EBITDA growth, 5.5% dividend yield. In my opinion, what more can you ask for? You're going to have a high dividend yield that's growing over time based on cash flow that is consistent and growing over time as well. We're not talking about 10 to 20%, cash flow growth. We're talking about, 5 to 7, and that's okay. We're not looking to, hit a home run. We're looking to hit singles, but consistently over time. The other thing I like about Enbridge is a lot of their CapEx, they're not, it's not one big project that is a $10 billion project that is subject to lots of regulatory risk. A lot of these are brownfield opportunities. A lot of these are utilities focused on natural gas, tuck-in opportunities. So low risk, small projects here and there that are just going to add value over time and continue doing what they're doing. At the end of the day, North American energy infrastructure, whether it's oil or natural gas, is very embedded. It's very reliant, and there's opportunities for growth and add-ons.
We are going to take a break. Rebecca Teltscher is taking your questions on Canadian Dividend Stocks. Oh, we're back. Paul in Edmonton, go ahead, please.
Hello. Yes, would you recommend in Canadian resources now at these price levels since the price has moved up a lot in the past month?
Canadian natural resources.
Yeah, this one of my favorite companies in the entire portfolio, and I feel like I always would say I'd be a buyer of this name forever, but you're catching me at a time where really, we've seen that move from $40 to $54 very quickly. But I see two sides of this. On the end of the day, it is a real Canadian success story, best run company in the world. one of the best Canadian oil assets with a low decline rate, premium. They have optionality with their gas that's not really well priced into the stock. So much opportunity there. At the same time, when I see, valuations move so quickly, like the yield dropped from 5.5% to 4.3% really quickly. So I would probably hold off for now, maybe try to catch it under $50. The way I look at it is all of the Canadian energy stocks are up right now because we've seen a sharp move in oil. If I'm looking at what is driving oil prices up year to date, a lot of them are not necessarily concrete evidence, more speculative. Is U.S. shale running out of steam? Is demand going to stay stronger than expected? Is the supply glut not as bad as people are saying? With OPEC plus. So, and especially is something going to happen geopolitically in the Middle East? There's a lot of things that have kept oil prices higher, but it doesn't seem. It's not necessary. I'm not confident that those oil prices are sustainable. So if we do see oil prices come down, just like today is a perfect example. I think oil prices are down quite a bit. We may see some of these stocks drop back, not because the stocks are doing anything wrong, not because CNQ is doing anything wrong, just because oil prices have come down. We may see it go back under 50. I would be buying it under 50.
Right. I mean, I know it depends on your time horizon. With the dividend yield, I suppose you could make a case, just buy it and hold on through the cycle.
Absolutely. And that's what I'm saying. It's like if your time horizon is 5 years, sure, buy it today. But I don't want to be getting any angry emails that I told you to buy it at 54 and then it's, $50 in 2 weeks. I mean, can I see it go down to $50 in a few weeks? Absolutely. But, in 5 years from now, do I see it getting higher? Sure. Yeah. Right. It's one of the best companies in the world.
And as you say, oil down about 1.4%, just over $62 today. Thanks for the question, Paul. Chris in Delta, BC. Go ahead, please.
Oh, hi, Andy. Great to see you back on the show again.
Thank you.
Like old times. Rebecca, I would just like to say to everybody listening that Rebecca truly goes above and beyond for all of her clients. And Rebecca, if I could please ask your opinion on Pembina Pipeline, where it's sitting today, and if you think it's a good time to buy, hold, or sell, and any thoughts on the space. Thank you so much. I'll hang up and listen.
Thanks.
Yeah, again, it's going to be very similar comments to what I'm saying about Enbridge and CNQ. Love Pembina. It's one of our largest holdings in the portfolio. I mean, we topped up all our clients at $50 to $51. I mean, there was a period of time, I think, where it dipped below 50 for like a few days. And, so all of our clients are topped up. So to see the move from 51 to, over $60 on Friday was amazing. It's giving it back today because I think, again, TD downgraded the name to a sector perform just based on valuations. Would I buy it today? Yeah, again, if I have my time horizon is 5 years, absolutely. It was definitely undervalued at $50. Is it fairly valued at today's valuation? Maybe. The yield was 5.5. Now it's 4.8. I still think that's a good sustainable dividend. I still think valuations are more reasonable than what you're going to be getting in other sectors like, technology or consumer discretionary. Gas volumes are going higher. And if we start seeing gas prices move higher, that's going to benefit them again. They have lots of projects that are based on take or pay contracts. So, even if the pipes are not full, they are still getting paid on a long-term basis. And that's what funds their dividend. That's how they're able to pay such a high dividend, is because their projects are backed by take or pay contracts. So I think there's a lot of opportunity there. And I think it's one of the names that we want to own forever. It's nice to see the move. A little bit more expensive, but I would say it's reasonably valued today.
We have Elizabeth on the line from Edmonton. Go ahead, please.
Good morning. My question is on GoEasy. This is a unloved stock, but it has a dividend of over 4%. I believe the price to earnings ratio is low. The pay ratio is under 40%. What's not to like about this stock?
Yield of about 4.7%.
Yeah, what's not to like about the stock is probably its risk profile. I think the management team is a good, strong management team. There was a short, I believe there was a short report last year.
Rings a bell.
the question is whether they were deliberately trying to hide those provisions. I kind of mentioned this when we touched in our introductory remarks about the Canadian banks and what happened with provisions last year. So just as a reminder, we had a lot of these Canadian banks take provisions for credit losses. So they decrease your earnings immediately when you think that there's going to be loan losses, so people are going to default on their loans or mortgages. They take those losses preemptively. And if they think that they're not going to come to fruition, they can put it back into earnings. There was a short report that was basically saying GoEasy was misrepresenting like what their provisions were, that their loan losses are actually bigger than what their provisions are. That seems to have, like that noise seems to have gone away. Obviously, the management team has said that there's no, truth bearing to that short report. Anything that's, to me, anything that is dependent on provisions and loan losses, I just don't think we are where we should be in the credit cycle to start buying some of these risk-on assets. In my opinion, like I said, I think the banks have gone a little bit too ahead of themselves right now. And this is a higher risk financial because we're not talking about, A lenders, we're talking about, lower quality loans. And I just think it's a little bit preemptive to say that the worst of the credit cycle is over and that things are great. It doesn't feel like things are great in the Canadian economy right now. I would like to see how this plays out in 2026. I would like to see what happens with some of these loans at really low rates, that were issued in the pandemic roll off and get refinanced now. I just don't think the worst is over. And I think that's probably why GoEasy is having a hard time regaining its footing right now.
We are going to take a quick break. We'll check out Rebecca's past picks. That's next on Market Call. Rebecca was on our show April 2nd of last year. Aecon, the giant engineering firm, was our first idea. Not a bad pop. Nice.
You're just going to leave it there? Okay, I can take over from here. Yeah, no, what can I say? I'm a genius. I am joking. You know what? The truth is, it was so clear to me at $17, the stock was undervalued. Do I think it's, a little bit expensive right now at 37? Yeah. Do I see? Can it go back down to in the low 30s? Absolutely. But I'll take it for now. Sure, I'll take that 110% win. Okay, so Aecon, they had these legacy projects that were causing them so much trouble because they took them on in the pandemic, and then everything just kind of blew up from there. Whether it was input costs, labor costs, delays, you name it. They had to take a lot of losses on that. Everything is pretty much done and over with, except, the Gordie Howe Bridge. You've seen it. Trump threatened it. These guys just can't get a break. But, it's almost done at this point, and it's just such a low percentage of their overall, earnings at this point. So, even if that bridge does get delayed, it's so minimal compared to the growth ahead of them. So, Aecon, we're looking at $10 billion in backlog. That is the record of the company's history. A lot of their growth projects are public sector. Demand keeps going up, and nuclear. They're doing all the refurbishments for Ontario, the Ontario nuclear projects, and they've also have some now new deals in the U.S. So they're building Canada's only. What is it called? The SMR, small modular reactor on the in Canada, and they also announced the Cascade deal. So in Washington State, they're going to be building 4 with the potential to build up to 12 SMRs. Wow. Again, that's not until at least 2030. But I think the idea that they are expanding into the United States, the idea that that nuclear power is kind of making a comeback. I think is all really positive. And again, with those legacy deals behind them, we stood by Aecon when the yield was 6%. They never cut the dividend. The stock was really underappreciated, had no love. And it's really nice seeing that patience really does pay off. And we're starting to see that show through now. So happy to keep owning it. A little bit nervous about the valuation, but again, over the long term, it'll be fine.
Perhaps good that it wasn't sold to the Chinese. Remember, the government blocked that.
Oh yeah, that was years ago. Yeah.
Premium brands. Let's see how this one did. Big maker of specialty food, processed meat, stuff like that.
Yeah. Again, so this is the newest stock that we added to our portfolio, so a little bit over a year ago, which goes to show how often we add new names. We're the type of, we'll do our research for about a year, and then, we maybe add one new name a year, because again, if we're going to own something, we want to own it for the next 5 to 10 years. It was very clear what the company was doing, a very good investment team. They were doing a huge expansion into the U.S., so they have a lot of the facilities and distribution in Canada, and they were basically doing a multi-year investment cycle in the United States to significantly increase capacity to be able to take on growth in the U.S. They have existing relationships with, for example, like a Costco. Costco in Canada is basically saying, "We love your product. Can you bring it down to the U.S.?" But they couldn't. They didn't have the capacity to do it. It's not that they couldn't do the sales. It's not that there was no demand. They didn't have the capacity. The amount of stores in Costco in the U.S. versus Canada is just is exponential. So they've been quietly building that capacity, and now they're able to take on that growth. I mean, for us, it was a no-brainer as well. That stock is, every time it reaches under $100, I buy a little bit more. It's great to see it doing what it says it's going to do.
A yield of about 3.3%.
Absolutely.
And we're tight for time. AltaGas, let's see how this one did. Not bad, 16% return. Lagging the market maybe a bit, but still respectable enough.
Again, it's half utilities, half gas distribution. I think sometimes the market confuses it, doesn't know where to place it. Is it a utility? Does it do gas distribution because they have gas pipelines and propane exports? We like both of their business segments. So I think they're both going to do very well. We continue to own it. We continue to add more to it. For us, 16% for a utility, that's great. It's down a little bit because it issued equity because they were going to retain ownership of a Mountain Valley pipeline that they're constructing. But again, they didn't take on more debt to do it. They're doing the right things, and they're starting to see strong demand for some of their projects.
Oh, okay. Yeah, slightly behind the TSX, but still, as you say, it's
well, the TSX, that's based on gold right now.
That's
so
right. Very different beast. Yeah, that's right. We'll be back with Rebecca Teltscher of Newhaven Asset Management answering your questions on Canadian dividend stocks. You can call her right now, 1-855-326-6260. We have an email from Lawrence in Richmond, BC. Could I get your guest's opinion? Now, this is on an ETF, XEI, the iShares High Dividend Index ETF, or just generally on dividend ETFs.
Yeah, I mean, as we talked about earlier, I think it's, that is a beautiful chart. We're seeing some, flows out of the U.S. into Canada, out of some of the higher risk stocks like technology, like, Bitcoin, and into some of the more value plays, dividend plays. So I'm not surprised. XCI is I would say, the closest ETF to our portfolio. So, has exposure to banks, pipes, utilities. Our weighting in utilities is higher, but, regardless, I would say it's the number one ETF that we recommend if you're not going to invest with us. Put it in XCI. That's the one we like. And that's a great looking chart. Love to see it because our portfolio would be similar tracking.
That's interesting. You generally have your clients in individual stocks. That's your modus? Individual
stocks. I mean, why pay a management fee to us if you're going to be also paying a management fee to ETFs? Even if they're low, these ETFs are not free. We're all about trying to maximize our return, our income to our clients. So, why pay a fee for the ETF if we're going to be replicating a portfolio that's very similar.
Right.
Then you get 100% of that dividend to you. With ETFs, they don't necessarily pay 100% of that dividend out. They may retain it. There's, a fee to manage it. There's a fee to, trade on it. There's a fee to have that, register, like that, the ETF registered. So.
Okay. Todd is standing by in Niagara Falls. Todd, go ahead, please.
Hey, Andy, happy to hear your voice on the show.
Thank you.
My question for our guest is about Constellation Software. I know it's not a dividend stock, but at these prices and evaluations, I'd love to hear every expert's opinion on it. Thank you so much.
And while I have you here, sorry, Rebecca, if you don't mind me asking, Todd, have you been a long-time shareholder in Constellation?
No, I've been a long time bystander, looking to get into it.
Okay, it sure is, Dan. Thanks very much.
We are also a long-time bystander, and it's not actually. I will like to. It's not a it's not a high-yielding stock, but it does have a 0.23% yield. It's not nothing, but to give it credit, most technology stocks have no yield whatsoever. So Constellation Software is what I'll say is you could be a very good company, but a bad stock, and I think for many years that's what Constellation Software was. Very well-managed company. They were a software company that was doing acquisitions and of vertical integration acquisitions, and they did a really good job of doing that for many years. And because of that, we saw very high valuations for 2023 to 2025. Think about it. That's exactly when the AI boom started taking hold in the United States. Very few technology names in Canada. So we had Constellation Software, Shopify, and more recently Celestica. Those are basically the three that gets all the flows of technology into Canada. And now we're seeing the reversal of that. Constellation Software started their reversal a little bit sooner than the others, like a little bit last year. We saw, some of that valuation come down. There are risks when you are a pure play, like an M&A, when you're growing by M&A, mostly by M&A. So, there's the risk of overpaying for an acquisition. There's the risk for an acquisition going wrong. There's a risk for the overall market valuations to come down, which is what we're seeing in the tech sector right now. So there could be an attractive entry point right now relative to historical. We're not taking our chance. I'm not saying it can't be a good stock from here. For us, our number one priority is preservation of capital. So I cannot be 100% sure that the capital of the price you're paying today is secure. I don't necessarily know if it's bottomed. Could we see it go down another 20%? I'm not sure. The move that we've seen in software stocks in the past few weeks can just show that there is necessarily no bottom on stocks that are priced very high. So, again, maybe continue to be a bystander here. But again, nothing wrong with management, nothing wrong with the verticals that they already own. But I'm not sure what the growth is going to look like in the future. And if they can continue, the bigger they get, the bigger the acquisitions are going to have to be able to move the needle. So I don't know if we're going to necessarily see a repeat of that growth that we've seen.
And we've got Lily in Montreal on the line. Curious about a broadly similar company. Go ahead, Lily, please.
Yes, hi. I bought CGI long time ago at $9, and I did very well until 1 year ago. Now it's dropping every day. I don't know what to do. Where you see CGI in the future, should I keep it or sell it? Thank you for taking my question.
Thank you.
It's such a hard question to answer right now because if you bought at $9, you're still up significantly. So if it was probably me, I would sell it. Even though, it's had a tough year. It was down, I think, 21% last year, and it's in free fall this year along with all the other technology stocks. Unfortunately, we're talking about CGI, right? So the ticker is GIB.
GIB, yeah. Oh, yeah, we put up the wrong thing there.
That's okay. That's okay. I just got confused for a second. I'm like, am I talking about the right thing?
GIB.A, as you say, Rebecca.
Yep. So, unfortunately, down last year. It's not one of those sexy software companies that were benefiting from the AI boom. So that's why it underperformed. Also, the government shutdown in the U.S. didn't necessarily help with some of their revenues that are government contracts. Yeah. And this year, it's getting caught up in that software trade. So, it's trading at $73. You bought it at $9. I mean, take your, you didn't sell it at the top, but you're not going to ride it all the way down. The real question is AI actually going to take over some of these software companies? Like, I don't know. I think it's too soon to tell. I do think some of these software, the sell that we're seeing in some of these sectors are overblown. That being said, I don't know what the future has in store for some of these software companies and some of these tech companies in general. If you're up, I would probably take the profits and redeploy them into something that has a better valuation. But, again, that's just me and my style of investing. Doesn't mean it's right or wrong. It's just how we do things.
Yeah. Isn't it amazing, though, if AI does de-skill so much of these high priests of IT that we pay so much to? Yeah,
right,
yeah.
Right.
Okay, we got to take a break. Rebecca Teltscher taking your questions on dividend stocks. We're going to be talking Ontario's Hydro One after this. Let's head to Kingston, Ontario. Ben is standing by. Fire ahead, Ben, please.
Hi, both of you. Very welcome to both of you. Thank you for taking my call. As Andy mentioned, I have a question about Ontario Hydro. Do you own Ontario Hydro, and what is your outlook for Ontario Hydro as far as appreciation and the also appreciation in the dividends that they issue? Thank you.
Hydro One.
Yeah, so, mentioned this a million times, love utilities. We don't own this one. It has the lowest dividend yield of the major utility players, about 2.5% or so. It operates in one regulatory body, which is Ontario, versus some of the other ones, like Fortis, they operate in many jurisdictions. So we like the diversification of the regulatory environment, whereas Hydro One is, just Ontario. Historically, Ontario hasn't been the best regulatory environment when it came to utilities. I think investors, particularly institutional investors, enjoy the simplicity of the model. Ontario utility, pays a dividend and it's just consistent. But it's trading at a really high premium relative to some of the other utilities. I think it's trading at 23.5 times earnings versus, Emera and Fortis that are less than 20. So, for that reason, I don't hate it, but it's not in my top 3 of the utilities that we would own.
Yeah, I'm showing a PE north of 25. Yeah.
I mean, depends on the numbers you're looking at.
Calculation and everything, but too high.
It's pretty expensive for a utility.
For sure.
All utilities are trading higher right now, but this is always traded at a premium, and I never understood why, because there was nothing about the asset base or their growth profile that warranted it, except for the fact that I think it's wildly institutionally held.
Okay, yep. And they can be a bit lemming-like, can't they? Well, everybody else owns it, yeah. Mike in Blind River, Ontario. Go ahead, please.
Hi, Andy. Hi, Rebecca. Nice to see you on the program. I have a question on Maple Leaf Foods, since they've spun off the Canadian Packers, and what the dividend growth will be in the future. And I look at the stock as a recession-proof safety net. So your thoughts would be appreciated, and thank you for taking my call.
Thanks.
Yeah. So Maple Leaf Foods has been, basically a turnaround story for the past few years. I mean, we really saw the stock outperform last year. As you mentioned, they did the spun out of Canadian Packers, which is their pork business. It is a staple, so I wouldn't necessarily say it's recession-proof because, they are branded and it is more of a higher end brand for some of their products that historically maybe hasn't been great performing in a recession. They do have brand risk. So, I mentioned in my past picks, I much prefer a premium brands. They operate under 60 different brands. Often many of it are discreet or not very well-known brands that don't carry the same, reputational risk or branding risk. If something, goes wrong with, let's just say if there's contamination in one plant in one product, it's not going to impact, the reputation of the entire brand. Whereas Maple Leaf has had that happen to them in the past. That being said, I think they're doing the right thing. I think they are a good turnaround story. I think, the dividend yield is pretty good right now at about 3%. I think that's pretty stable for here, and it's pretty high for a staple. Again, like I said, I prefer premium brands, but I don't see anything wrong with Maple Leafs from here.
We're going to take a quick break. We'll have a look at Rebecca's top picks when we return. Join us tomorrow on Market Call. Michael Hakes will be on the show, Senior Portfolio Manager at Murray Wealth Group, taking your questions on US and global stocks. Time now for Rebecca Teltscher's top picks, and we're going to kick off here with ARC Resources, a producer of natural gas and, of course, liquids.
Yep. So they reported earnings a couple of weeks ago. If you could just pull up a short-term chart, you'll see what I'm talking about. The earnings were actually okay, but the problem is that they withdrew guidance for Attachie, which is one of their new growth projects. They've had problems, I think, too much water in the wells. And then you could see right there, they reported earnings, stock dropped 10%.
Ouch. Yeah.
We thought that was completely overdone. I mean, the market was basically pricing in a zero value for Attachie as if that project's never going to go through. Essentially, that project still has a value. Maybe it's going to be delayed. We think the management's doing the right thing. They are intentionally slowing down development at Attachie to optimize the well, as opposed to just deploying capital into something and seeing what's going to happen. I think what they're doing is more prudent. They're one of the largest and best gas companies in Canada. We think patience is going to be rewarded. We think the market wasn't being patient on that day. We've seen it recover a little bit since then. But once we saw that drop, we've been buying or adding it to for all of our clients, since we think this is a good long-term opportunity.
Market shooting first in that case. Yeah. Emera, the utility, what draws you to this one?
Again, love utilities. And it's hard to recommend a company that is trading, that the stock is almost at all-time highs. I did add it. I mean, it's up again today. I was able to add some to our clients at around $68, but now it's over 70 again. It's what we talked about is a diversified utility relative to a hydro one. Their largest regulatory environment is in Florida, which is historic. One, it's the fastest growing, population growth in the United States. And very positive regulatory environment. They're very conducive relative to Canada. We've seen some weakness in, they also own Nova Scotia Power, which has seen, a rate cap over the past few years. We're a few weeks away from seeing like that rate decision and whether they're going to be able to increase rates. I think it's that struggle between reliability and affordability for clients. But with regards to Florida, there's so much that they're able to grow on, whether it's, converting coal to gas, storm hardening investments, and just general population growth and adding more solar investments. I think they're able to have 7 to 8% rate-based growth over the next, couple of years while maintaining a 4% dividend and growing it, slowly, but they're still growing it.
And finally, Telus, what attracts you to this one?
Yeah, I mean, this one, it's funny because, when they announced the CEO switch from, Darren Entwistle to Victor Dodig from CIBC. I mean, we, Ryan and I were like, wow, like this is fantastic. And then the market just, it's been down since then. If you go shorter term, you'll see.
It was surprising bringing in a banker to run the company.
You know what, though? Look what he did at CIBC. He was able to bring out a lot of growth there. And if you look at what Telus needs to do over the next few years, they need to bring debt down. They need to monetize some assets. Some of it's going to be maybe the sell of Telus Health. Maybe it's going to be the sell of some real estate. These are all things that Dodig has experience in as a banker. I do think that maybe they do need a banker right now to be able to get the company in a financial position that they need to be in. Telus is already a structural leader in the group with regards to the telcos. They are already growing faster than the other telcos, and they are already further ahead with regards to their CapEx spending from the fiber to the home build. So on that sense, they're already there. I think the stock is down because there's not rumors, but there's expectations that maybe this new CEO is going to cut the dividend. Do I want to see a dividend cut? No. Do they need to cut the dividend? No. Will they cut the dividend? I don't know. Maybe. I mean, Bell didn't need to cut, BCE didn't need to cut the dividend, and they did. I think it was to appease institutional investors, and maybe it's going to be the same case here. If they do cut the dividend, I don't think the stock is going to, get hammered. I think it'll maintain. I do still see long-term value. If they do cut the dividend, the yield will probably still be about 5%, similar to yield, but similar to Bell.
Right now, 9%. Yeah.
In the meantime, I am absolutely collecting that 9% yield as we wait to see what's happening. But again, I think Victor's the right man for the job, and I'm excited to see what he can do.
Yeah, and they have stopped growing the dividend for now, if I
that
remember
was
rightly.
That was the announcement. I think there was speculation that there could be a dividend cut, and then they made the announcement at the end of last year that they're not going to cut the dividend. They're going to pause dividend growth. They were growing their dividend twice a year, and so they were going to pause dividend growth and then eventually slow down the DRIP discount to zero. So Again, they don't need to cut that dividend. That CapEx that, from the fiber to the home build out is coming down. They have billions of dollars they can monetize, whether it's the copper in the ground, real estate, health. They have lots of flexibility. So I don't think they will cut the dividend. If they do, it's not the end of the world.
Rebecca, thank you very much.
Thank you.
Rebecca Teltscher, thanks for watching Market Call.